Tonight we celebrate Halloween, our great national secular holiday, by doing it the Mad Money way, by talking about the stock of Hershey. Not because it makes a huge percentage of the candy that you'll probably be giving out tonight, but because Halloween's supposed to be scary. And for the past 3 weeks, almost nothing's been more terrifying than being a Hershey shareholder. The stock has plunged from 196 at its highs earlier this month to 169 and change as of today. When the company reported yesterday morning, it wasn't enough to turn things around. Now, the stock actually tumbled from 175 to 171 yesterday. Before seeing 169 today, this is baffling. Baffling. What is going on here? Why has this iconic candy maker become such a heinous stock? The truth is, Hershey's been struggling for the last 2.5 years. Now, I think a lot of that's largely because of the GLP-1 weight loss drugs that have hammered the entire packaged food industry. People just don't want to eat anything bigger than this when they're on those drugs. At the same time, they also struggle with sky-high cocoa prices, although that's gotten substantially better over the last 10 months. However, I got to tell you, I think the worst might be behind this one. Really, I do. This summer, Hershey hired a new CEO, a fellow by the name of Kirk Tanner. He previously ran Wendy's, but before that, he spent roughly 3 decades at PepsiCo. And he officially took over in mid-August. I remember flagging that to you that I thought was really great for Hershey, not for Wendy's. So far, though, he's had his work cut out for him. When Hershey reported in late July, right before Tanner took over, the company delivered a complicated quarter. This was a clear top and bottom line beat. But management cut their full-year earnings forecast because of the tariffs and the cost of the hedging program they put in place to manage the volatile price of cocoa. Interestingly, the stock spiked immediately on the news, reaching its highest level since last December when we were hearing ridiculous rumors, and I mean it, ridiculous, of a takeover from Mondelez. But then it came right back down. Since then, the action in Hershey's been choppy, turning to downright horrible over the past few weeks. I mean, sell. And that brings me to yesterday morning when Hershey reported again. Now, at first glance, I thought their numbers looked pretty darn good. Hershey posted net sales of $3.18 billion, which was up 6.5% year over year and above the $3.12 billion that Wall Street was looking for. Get this, organic sales growth came in at 6.2%. Almost all of which was driven by price increases. Still, that's a really good number for any packaged foods company, especially these days, especially, by the way, when the analysts were only looking for 3.6% organic growth. So what's the problem here? Well, on the other hand, Hershey's adjusted gross margin was 31.8%, and that was down a staggering 850 basis points year over year. 850 basis points? Reflecting, quote, here we go, higher commodity and tariff costs along with unfavorable mix, which more than offset net price realization, supply chain productivity, and transformation program savings, end quote. All right, that's obviously not ideal, but this was something everybody coming. I thought it was expected. In fact, the analysts only expected Hershey's gross margin to come in at 31.5%. Put it all together, and they earned $1.30 per share. Now, it is down 44% year over year, but again, much better than the $1.07 per share that Wall Street was anticipating. At the same time, Hershey raised its full-year forecast, but not by all that much. Management took up the low end of their earnings guidance by 9 cents, which is not much when you're projecting $5.90 to $6 per share. Given the size of the beat for the third quarter, that modest increase to the full-year forecast was seen as a bit of a disappointment. When you report a 23-cent earnings beat and you don't raise your full-year forecast outlook by more than 23 cents, well, that's practically a de facto guide down. Worse, on the conference call yesterday, management seemed pretty cautious. For one thing, they noted, and this is what I think is hurting, this Halloween season, it hasn't gone particularly well for Hershey. And they said it was starting slower than expected, thanks to warmer weather and a concentration of seasonal purchases in the final week, because guess what? That's what happens when Halloween falls on a Friday. The company also pointed out that it had some timing benefits in the third quarter that should be reversed in the current quarter. Oh, they also said the Mexican business isn't that good, but you know, this is a company that really, Halloween matters a lot here, obviously. Looking forward to 2026, Hershey seems cautiously optimistic that things can get better, with an emphasis, by the way, on caution. I think management just doesn't want to stick their collective neck out for something they may not be able to deliver. They repeatedly emphasize that they're playing for the long term, not necessarily this quarter, current quarter, or even next year. I like that. Put it all together, and you can understand why Hershey stock has gotten pulverized after the past couple of sessions. I can't say that that's an unreasonable reaction to the quarter, even as the stock was already down hard going into the earnings. But, and this is a pretty big but, you might want to take the other side of the trade here. When you look at the quarter, those results were legitimately very good, much better than we've gotten used to from Hershey over the past few years. I actually appreciate management's cautious tone here. Remember, CEO Kirk Tanner's only been in charge for less than 3 months. This guy's a pro. Pros know you want to underpromise so that you can over-deliver UPOD in the future. I'm not alone in thinking that it's time maybe to get a little more constructive here. Overnight, analysts at Piper Sandler, they upgraded the stock from underweight to sell to neutral, citing reduced uncertainty. They also think that while cocoa prices could remain inflationary, that could moderate as 2026 comes in fully into focus. I agree with that, too. Honestly, if you don't have any position in Hershey and you want to diversify away from the pure tech like so many others are trying to do, yeah, it's tempting. Tempting to put on a small position here. With the stock down at the lowest level since early July, sure, Hershey still looks expensive, selling at 28 times this year's earnings estimates, nearly 25 times next year's. But if I'm right that management's being deliberately cautious with its forecasting, then there's a good chance next year's numbers will come in higher than expected, making the stock a lot cheaper in retrospect after this big fall. So here's the bottom line. Hershey's been through a very difficult few weeks, coming on the heels of a tough couple of years. Their results have been muddled, including the quarter that was reported yesterday, as the new management team has only just taken over. In fact, they've been very conservative when talking about the future, but I like that. Frankly, I think that even if the stock hasn't bottomed yet, it's probably close to a bottom, although this one only works if you believe in Kirk Tanner's leadership. I'm a believer, though. I just wish it had been a happier Halloween and less of a trick and more of a treat for this peerless brand. Let's go to Bob in my home state of New Jersey. Bob.
Hey, Uncle Jim. Booyah.
Booyah, Bob. What's happening?
Frank, I finally got through to you. I bought some Target a while back when it was at its high, and I got rid of half of it. I just hung on to the other half, but it doesn't seem like it's doing anything, and I kind of figured maybe by Christmas it would hopefully go back. What do you think about that?
Well, it does have a new CEO, and we haven't seen the imprint yet. I will say this. These stocks are so out of favor that even if you buy the best of them, they're not working. A longer-term view would say that it's time to buy Walmart, or one that I talked about with Jeff Marks and I on the for the Charitable Trust, which is that Costco has come down so much that I think Costco is the way to go. I don't care so much about the yield. Target has a big one. I care about growth, and Costco's got that. That's the way to go. And let's go to James in Ohio. James.
James, I was just, it's an honor to speak with you today. Just like you, I'm a former resident of Philadelphia, and I want to give you a big-time broad and only booyah to you, brother.
Oh, come on, man. You know my mom is from about 10 blocks away. She's from Broad and Lindley. I mean, we got a stone's throw. What's going on?
James, I've been Costco hit an all-time high back in February, and I've been watching it like Burt Lancaster and Run Silent, Run Deep, things going down, down, down. And I don't know, is it a time to reduce my position, buy more, hold on? I know they have a new CEO now, and I don't know how that's affecting the operation. So I'd be interested in your take on that.
Okay, it's funny, and people have to understand, I actually do not know the questions ahead of time, and I just literally talked to a caller, and I was saying that I think that Costco is right. Now, when I say Costco is right, it sells at 45 times earnings. It typically is never cheap. I remember this from the old Berkshire days with the late Charlie Munger. Can you just start buying something because it seems at 45 times earnings? I think you can start a position. We own a long-standing position for the Charitable Trust. I don't like to violate my basis, but Costco is the best buy in the industry. I think it's been hurt by a piece in a major magazine about how maybe the best times are over. I just don't think that. So anyway, I agree. Costco's good, and go Birds. Look, Hershey's had a couple very rough years, but I think now might be an interesting time to start a position. It's down so much. Got a new CEO, Kirk Tanner, Total Pro. Much more Mad Money ahead, including my exclusive with Columbia Sportswear. Shares slipping after earnings to the lowest level since early 2016. Maybe investors are getting a buyer opportunity. Let's find out by going right to the CEO. And investors were spooked by Meta's earnings report. I think many are failing to see the forest through the trees. I'm going to break it down and give you a very opposite view of what everyone else is saying today. And then, of course, all your calls rapid fire to tonight's edition of the Lightning Round. So stay with Cramer.
Don't miss a second of Mad Money. Follow @Jim Cramer on X. Have a question? Tweet Cramer. #MadMentions. Send Jim an email to madmoney@cnbc.com or give us a call at 1-800-743-CNBC. Miss something? Head to madmoney.cnbc.com.